Equity indices function as mathematical abstractions, continuous calculations tracking specific baskets of companies, smoothed into a single geometric line. While often treated like individual stocks, they exist primarily as benchmarks rather than discrete tradable securities. Because the calculation itself cannot be owned, the financial industry developed derivative proxies to gain exposure: futures, exchange-traded funds, and mutual funds. These vehicles now dominate modern market participation. Today, the daily dollar volume for S&P 500 futures products alone runs into the hundreds of billions. Investors buy and sell exposure to the entire equity market instantly, in massive size, around the clock. Navigating this scale requires a specific framework. Successful index trading aligns three distinct elements: the underlying mathematical weighting of the benchmark, the structural mechanics of the derivative proxy, and the raw price action on the chart. Standard Forex or single stock logic fails here. Currencies respond to sovereign interest rates and trade in pairs, while individual equities remain vulnerable to sudden, idiosyncratic earnings shocks. Trading in indexed involves analyzing a macroeconomic aggregate. It requires identifying the institutional order flow hidden within a benchmark, stripping away the noise to see where the heaviest capital is actually moving. Every index movement observed on a screen is dictated by its underlying classification and weighting rules. This shows market capitalization weighting. In benchmarks like the S&P 500, the largest companies exert the vast majority of influence. If a single mega-cap component surges, it drags the entire aggregate upward, even if smaller companies are flat. Contrast this with a price-weighted index like the Dow Jones Industrial Average. Here, influence is dictated strictly by the nominal share price. A $300 stock moves the index far more than a $30 stock, regardless of the company's actual economic footprint. To counter these biases, some benchmarks use equal weighting, giving every stock the exact same allocation, or fundamental weighting, which ranks companies by revenue or cash flow rather than share price. But non-standard weighting creates its own friction. Keeping hundreds of stocks perfectly equal weighted requires constant, aggressive portfolio rebalancing, which escalates execution fees and structural slippage for the funds tracking them. Traders in these products are speculating on a specific set of algorithmic weighting rules rather than the market in the abstract. Because the index calculation itself cannot be bought or sold, market participants rely on proxies to gain exposure. Retail investors often use fully funded ETFs, which carry management expense ratios and tracking errors. Active traders lean toward cash-settled forward contracts, like index futures, which require only a fraction of the notional value up front as margin. This is a specification table for CME Micro E-mini futures. Looking at the S&P 500 row, the contract uses a $5 multiplier with a 0.25 minimum price fluctuation. Moving to the NASDAQ 100 column, the multiplier drops to $2, reflecting distinct volatility. Because these futures contracts are unfunded forward transactions, their market price must account for the costs incurred holding the asset over the contract's life. This is the cost of carry. The fair value of a futures contract equals the current spot price plus the financing cost of the forward transaction, typically benchmarked to the secured overnight financing rate, minus the expected dividends prior to expiration. When the implied financing rate of the contract deviates from the SOFR benchmark, you get what institutions call roll mispricing. The contract trades rich or cheap relative to its true value. Trading index futures involves a simultaneous speculation on corporate equity, the cost of capital, and dividend forecasts. This snapshot of NASDAQ components reveals that each specific technology stock carries high idiosyncratic risk, the vulnerability to sudden gaps driven by company-specific earnings failures. Index aggregation dilutes these individual shocks. A 20% collapse in a single mid-cap stock is absorbed by the broader basket, producing a cleaner macro trend. This smoothing effect is amplified by index survivorship bias. As companies underperform, index providers routinely eject them and replace them with stronger entities, hardwiring an upward bias. This bias creates distinct market regimes. The primary state is the trending regime, fueled by systemic economic growth and relentless institutional capital allocation pushing the aggregate higher. The secondary state is the mean reverting regime. During a bear market, fear-based selling spikes volatility, driving prices to severe statistical extremes. These overextended conditions attract institutional buyers, sparking rapid upward corrections back to the historical average. By stripping out the noise of isolated corporate failures, indices provide price action traders with a structurally cleaner dataset for plotting entries and exits. In modern index markets dominated by quantitative algorithms, traditional technical indicators often fail. Because they smooth historical data, they confirm momentum shifts only after the primary move has already executed. Raw price action trading abandons lagging formulas to study the direct footprint of price itself. It is the real-time analysis of candlestick behavior to locate where institutional order flow is overwhelming retail liquidity. The foundation is market structure. A trader reads the naked chart to identify sequences of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. The intraday bone zone uses a 5-minute chart with 9 and 20-period moving averages. Following an initial move, the trader targets a pullback into this space. A green candlestick closing inside the zone triggers entry, with a strict stop-loss below. Pullbacks buy at a discount. Breakout strategies, conversely, buy into strength. They aim to capture the rapid momentum expansion that occurs the moment price clears a defined consolidation range or previous candlestick high. These naked price action setups work precisely because large algorithmic models cannot hide their size. They are mathematically forced to execute trades and manage heavy liquidity at these specific structural levels. Professional index trading requires mapping the macro market structure and executing within it using micro price action triggers. Indices represent highly specific macroeconomic aggregates defined by rigid calculation methodologies and priced through complex derivative contracts. By shedding delayed mathematical indicators, you look past the retail noise to see the raw institutional order flow that actually drives global benchmarks. The highest probability trades emerge when the macroeconomic bias of the broader index and the immediate price action signal on the chart perfectly overlap. Mastering global equity indices is a transition from understanding mathematical formulas to reading the raw human and algorithmic psychology on a chart.